Good morning, everyone. I'm Vince Lancy, and this is the Gold Fix Market Rundown. It's 7:45. There's the homepage. We'll be talking about two stories on the right-hand side there. Bloomberg notes China's record gold ETF outflows. We'll be going into that. And we're also going to touch on the founder's post, no rate cut expected due to goods inflation. We're going to give you the bottom line on that so you can manage your own expectations. Let's start with the markets themselves. 10-year bonds, 432. The dollar is 99.02, up 12. Nice little run lately. S&P 500 is 63.84, up 13. The VIX is 1563, down 34. Gold is down $2, was up $2, vacillating around unchanged at 33.24. Silver weaker, 37.86, down 27. Copper 5.56, down 4. The silver copper industrial trade seems to be on. Oil 69.67, down 42. Physical commodities a little bit softer, pullbacks after the last couple of days. Natural gas down 2 at 309. Bitcoin 117,800. There's a ledge forming there. We'll show you that in a chart. Ethereum weaker, 37.59. Palladium up 5. Platinum down 1. Gold, silver up 72 today. So can't get below 86, can it? And grains are very mild and very mixed. Soy unchanged offered, corn unchanged bid, and wheat down almost 2 cents. We'll take a look at those charts in a minute. Let's get to the stories. First story, Bloomberg has a story out today, and we have the link to that story in our write-up. They note China's record gold ETF outflows. And sideways gold meets rising stocks is essentially the vibe from it. Chinese gold ETFs saw record outflows in July as retail investors rotated into rising domestic equities. Bloomberg framed this as gold is stalling. That's not a quote. Sideways was their word. But structural forces suggest otherwise. China's accelerating M1 money supply supports both equities and gold, supporting inflation and challenging Western central banks' 2% inflation targets. Now, we note, in contrast to the story, that Bloomberg is expanding its data business in China and benefits from equity optimism. In fact, they note in their report that commodity equities are doing very well. So gold's price remains in a consolidation near record highs, unlike underperforming Chinese bonds, which are getting slammed as people go risk on. Retail repositioning appears tactical, not foundational. The story is less about abandonment of gold and more about general reflation entering China's market space, set against the backdrop of deepening global liquidity and strategic reallocation, all of which is bullish for equities in China, for sure, for gold, and for commodities in general. So we had the full analysis in the premium post. Bloomberg notes China record gold ETF outflows, as well as the link to their story. That's the story. And I guess editorially speaking, they left out that the first half of 2025 was record inflows for gold ETFs, like massive inflows for gold ETFs in China. So if you look at gold globally, India is buying ETFs now. So go figure. It just seems to be rotating around the world. The next story is Fed decision day, why a rate cut is very unlikely, at least that's our opinion. The Federal Reserve is not expected to adjust interest rates at its upcoming July meeting. That's today. Despite persistent calls from some officials to ease policy. I think there's two that disagree, which is odd. The broader committee appears inclined to keep the federal funds rate unchanged. The decision reflects a growing divergence between rising inflation in goods categories and softening private sector employment growth. Right? We have a couple charts here we're going to pull up for you as soon as I can get them sorted. The first chart is inflation. Now, the light orange line, salmon, is the one-year inflation swap, and it's indicating since the middle of June, an increase in short-term inflation expectations. So the Fed, that's a guide for the Fed. And if they're swearing by the data, that's got to stop them from being more aggressive cutting. We don't know if they're swearing by the data anymore or what data they're using. The other thing we'd say, just to give you a counter to that, is a lot of that data was based on the expectations of tariffs really cooking the books on inflation, and it hasn't done that yet. So perhaps that beginning of a downtrend there is something more significant. So that's the inflation side of it. Inflation, by the numbers, says it's really not a good idea to cut. Unemployment is also interesting. We may be at the beginning of a bigger trend here. Okay, so unemployment's been muted. It's been steady. But there is a change in the mix. Now, the light orange, that's the private sector hiring people. And all we've been hearing about is people getting laid off now because of AI, and that's valid. The orange, the darker orange sector, that's government jobs. Now, the blue are our markings. These charts are from Bank of New York. The blue are our markings. And if you take an eye and you look starting, say, November, when or December when Trump started, you'll see that the new hires for jobs were private sector almost entirely, with very little of the government hires adding to the payrolls. And that's probably in part Doge scaring government into not hiring people. However, in June, government workers seem to be filling the gap again as private sector hiring drops. And the blue rectangles on the left, that shows you where they were big last time under Biden. And so you have to wonder, is unemployment really worse than it looks? And are we going to see a big downtick in that? So I think right now, until we actually see a manifestation of people not working people getting laid off at a faster pace, the Fed's going to hold off on its cut. The bottom line is unemployment isn't high enough and inflation is creeping up again, at least perceived to be creeping up again. I would say that the street is expecting 2 cuts. So not July, yes to September, maybe, and yes to December, definitely. So Wall Street's been dovish, more dovish than the Fed for 2 years now, 4 years, actually, when you think about it. So the ironic thing is, just as an editorial comment about stocks, the ironic thing is, despite Wall Street being dovish and being disappointed by the Fed time and time again, stocks are at all-time highs. So either that's a bubble expanding, or that's the fiscal spending going towards making America great again. It's probably a little bit of both, and we'll see. Moving on to the charts. Starting with gold, those are the moving averages. As you can see, we're just messing around with the 50-day moving average, and gold needs to pick a direction. We did have a false direction pick here, right? I was long and got stopped out. The 100-day is coming along. When the 100-day approaches the 50-day, your speculators will start to pay more attention again. Which way, you don't know yet. But usually when the market creeps up to the 100-day, when the 100-day creeps up to the market, you have even more volatile sideways movement. I don't know, but that's what I've seen historically. And then it picks a direction. So we could be this way for a while. And I would remind you, bull or bear, that we have now been, after making this high in April, May, June, we're 3 months into this sideways action. And I can't see this being a top. Now, of course, I'm biased. We had 2 months of sideways action before the spike up after December. So just keep in mind that I think the rest of the commodity markets are catching up. Just to paraphrase Hartnett, gold was the outperformer in phase one of dollar weakness. And now, because it's recessionary dollar weakness, we're worried about recession. Now you'll see risk on commodities outperforming in phase two, which is because the world's going to start goosing economies again. So I think he's been spot on that. I mean, oil is showing that to you now. All right, moving on to silver. Those two dotted lines are my levels, so maybe silver is establishing a new trading range up here. I don't know. But there seems to be a battle now. If you think there's going to be a reflation or an expansion of an exporting of inflation coming out of China, then you buy copper, then you buy silver, or maybe you buy copper and you look at silver. If you think there's going to be more tariff risk, you buy gold and copper. Anyway, it's hard to say, but hey, we're up 33%, I think, year to date. So I think the gold silver ratio, once it cracks 86, will go to 79. Again, gold silver ratio below, I'll pull that up for you. Gold silver ratio below 90, that's 2.5 points away, should get us to 79, which puts silver at around $43. I also want to look at Bitcoin. Everyone's buying everyone. Everyone's buying Ethereum right now, and interesting how Bitcoin is just kind of ledging. I don't know what to make of that, except I know that somebody's involved in the market, either propping Bitcoin up and catching it while everyone's selling Ethereum, probably BlackRock or Sailor. But just something to watch. It's very, very artificial, that market, especially since it pierced it, went back above it. Oil, very busy chart. Those two lines are legacy lines from the last time I identified a trading range. Well, we're back in it. And it's hard to say, but if you believe that China is going to inflate or increase its money supply, and you believe that the US is increasing its money supply, whether it happens today or later on, then you want to start buying risk-on commodities. So basically, it's risk-off commodities when they thought we're going into a recession. Now it's risk-on commodities when they think we're going to have a boom. But we're probably going to have a boom. Anyway, I'm Vince. Gold's up $4.50 now. Silver's down 20, and copper's down almost 4. I'm Vince. Have a great day.